When markets fall because of war, three kinds of investors appear. The first one exits, waits for clarity, waits for the headlines to soften, comes back when things feel safer. But markets don't wait for courage. By the time he returns, the recovery has already run. The second one enters. No prior investment, just a clear head and a simple belief. When fear drives markets down, not fundamentals, every rupee buys more. He steps in when everyone else steps out. Lower NAV, more units. The same long horizon. He times the market. He seeks value in the discounted units. The third one tops up. Already invested, already staying the course. During panic, he reaches in and adds more. Compounding on compounding. He didn't see volatility as a threat. He saw it as an invitation. 45 years of the market's history. 8 major geopolitical crises. In 7 out of 8 cases, markets delivered positive returns in the year that followed. Staying invested is discipline. Adding to your portfolio when fear peaks is intelligence. Are you a consistent investor? Good. Are you also an opportunistic one? That is where the real difference is made.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.